Hello, Altos members. I'm Sophia, Director of Market Intelligence at Altos Trading. Today, our Chief Investment Strategist, Jeff Tompkins, has put together a special training video for you. He will walk you through the exact steps for identifying when an options gamma squeeze is ending and the underlying stock is likely to reverse. This is a must-see, particularly because there have been a lot of gamma squeezes in the market lately. Let's get over to Jeff.
The entire market's been in a gamma squeeze. So the sell-off that we had in March, where we had heavy put open interest, not a lot of call buying, and we also had heavy short open interest, all unwound very rapidly and caused this big parabolic up move in the market. And so this is a classic gamma squeeze, but we've seen it in individual stocks. Classic one that because it was so extreme and made a lot of headlines even was in Avis back in started kind of back in the latter part of March and persisted through around the third week of April and then unwound. So this is a good one to look at because it's actually unwound, right? The one we're in the broader market has not. We'll look at another one. There's another pretty big one. I mean, there's a number of them, but we'll look at a different one that hasn't unwound. But this is what it can look like when it does unwind. So that's why you want to be extra cautious buying in to gamma squeezes. So if you're going to trade them to the upside, you obviously want to get in as early as possible. But once something like this has gone parabolic, you don't want to be buying in. And they can go on for extended periods of time, right? This one went on for about a month. And so they can last for a while. And it's probably one of the most challenging things is identifying when they're over. But when they are over, you can see what can happen, right? And so there's a number of things. And that's what we're going to look at is trying to kind of identify when a gamma squeeze like this that creates a parabolic move up in whether it's a stock or an index is losing steam and likely to reverse. But it can be very violent, very rapid, and often price will come back down close to where that gamma squeeze started. Not always, but often it will, especially with an individual stock, like in this case with Avis. But another one that is a great example that hasn't unwound is Intel. So back towards the end of March, Intel was trading down in the low 40s, and it just recently breached 130. Okay, and it's gone parabolic. So this is what a gamma squeeze looks like, and this wasn't absolutely a gamma squeeze. Okay, so what happens here? First, you have to understand what it is. And let me get it. So what's going on here? Why did, how does a stock go from 40 to $130 a share in a month? Well, you get a feedback loop that causes this. And that involves heavy call buying. And then when retail goes out and buys calls, the market maker has to sell the calls to the retail call buyer. And the market maker, of course, isn't going to take directional risk exposure. So they're going to go out and hedge by buying shares of the underlying stock. So you get heavy call buying, and then you get market maker delta neutral hedging. That causes what you see right here. Okay, that causes kind of parabolic move and gamma squeezes. Okay, so the hedging alone by the market maker can move the price and cause this kind of parabolic move. And so when market makers are short gamma, the hedging is what causes the rapid move up in price. So market makers are buying as price rises, but then they'll sell as price starts to fall. So that's where it gets dangerous. So at the very first sign that that parabolic move starts to reverse and it actually materializes and does start to reverse, think think about what the market maker has to do. They have to then unwind their long shares, right, to stay delta neutral. And that's where that cascade starts, where price starts to really fall. And it looks like, I mean, it looks like that might be starting here in Intel right now. Okay, it's not a guarantee, but there's a couple clues. And this will tie in because I'll walk through like the things to look for, but we put in a lower high today. Okay, because prior to that, we're putting in higher highs. And it wasn't just a slightly lower high, it was significantly lower. Okay, we also had a big range expansion. We had heavy volume. We had a bearish close. Now we did pull back up off the low, the session low, but this whole parabolic structure has changed. So if you look back from when this started, you don't see this anywhere. You see a few down days here and there, but nothing like this. So this might be the first clue of the gamma squeeze unwinding. Um, but that's what a gamma squeeze is. So you have to obviously first understand that. Now we're going to look at the signs that could be ending. Like how do we identify when this might be turning over? Because then we're going to look at how could we trade this to the downside, right? Because those can be really great opportunities. Because again, when they unwind, you often get very heavy selling and big price reversals. So that creates opportunity. So let's look at some the ways to identify when it's a gamma squeeze is ending. So number one, price stalls despite high call option volume. Okay, that's one. So if you still see high call volume over in the options chain, but price is not following suit, that can be a sign. Let's just actually, I haven't looked at this yet on Intel, but we can go over. Okay. So like if we just look at this Friday's expiration, there's still huge volume on the call side. And if you reference that to the open interest, like you look up the 125 strike, okay, these were call buyers because volume greatly exceeds open interest. So we're adding, right, call volume to open interest, and these are call buyers. Same thing here at the 120 strike, but there's heavy volume still, even when the stock's down over 6%. Okay, so that would be one sign. And you could look, out at different expirations. Oh shoot, I didn't want to erase my text there. I'll put that back on here. What did I say? Price stalls with high, or let's see, while there is high call volume. Okay. Number two, um, the call implied volatility stops rising or starts falling. So if you look over in the options chain at the implied volatility column, if it stops going up and or stops falling or starts falling, that's an indication of a decrease in demand for call options. So that means there aren't as many call buyers coming in. Okay, three would be call volume shifting from aggressive buying to profit taking. Okay, and you'll generally see that align with number two, call IV, rise, stop rising or start falling. Okay. Um, Number four is what's number four? Key strike fails. In other words, so like a key strike would be 120, 130. So 130 is a key strike, right? We saw all that heavy open interest and volume at that strike. And then you want to look at the price and what did it do? It tested it on Friday. It breached it, and maybe it breached it actually on Friday too. Pulled back, breached it on Monday, pulled back, and see how price rejected it. So we're getting a key strike fail at 130, which is a strike with heavy volume and open interest. Okay. Expiration uh, cycle ends. So if there's a key expiration cycle where there's been heavy volume and open interest, or it's like a monthly expiration cycle, like a third Friday of the month, or a key weekly expiration cycle, that can often reset things. So often you'll see these gamma squeezes unwind around key expiration cycles because obviously all that open interest comes off the table, right? Those options expire. And then the market maker who sold those call options and was long the underlying shares as their hedge has to sell the shares back. So that can either start or accelerate a gamma squeeze reversal. Okay. And then the last one is um, we just looked at on Intel here in today's price action. You put in a lower high or break a key support level. Okay. So those are the six things that are good indicators of a gamma squeeze coming to an end and reversing. All right. So what I look for is at least four of these six. So sometimes you might have all six, sometimes you might have five, but at least four of these to line up. So four of these things happening are a very good indicator of a gamma squeeze coming to an end and reversing. So you might have, right, price stalling out while there's still high call volume. Okay, we have that right now on Intel. We just looked at the option chain, there's still high call volume, but price is stalling. We have a lower high. We're coming up on a Friday expiration, but five, I wouldn't say we meet yet. We failed a key strike, right? The 130. I'd have to do a little more analysis to see if call volume is actually shifting from aggressive buying to profit taking. I haven't really been monitoring that. Same thing with call implied volatility rising or stop rising or start falling. I haven't been monitoring that. But I can say that three of these are definitely in place right now, and perhaps four or five. I just have to do a little research there. Okay. But those are the criteria to look for. And then once you've identified it, okay, then you can start looking for opportunity to trade it to the downside. So then we can use put options to trade it on the way back down. So the aggressive, well, let me type this. The aggressive thing to do, if I can type here, is to buy an at the money put. So if you're expecting a really sharp, fast reversal back to the downside, just buy an at the money put. Okay, because likely the put premiums are deflated a little bit with the parabolic up move, implied volatility maybe down. In this case with Intel, it's not. It's actually pretty elevated, so they might be a little more expensive, which I'll give you option two here in just a second. So you want to take the implied volatility level into consideration, the expense of the put premium and all that. But if you can get them for good deals when IV is low, they can really blow up because obviously if you get a swift major sell-off, implied volatility is going to spike, which is good if you're a put buyer. But then so that'd be the aggressive way to do it. And again, you want to use variables like implied volatility levels to determine whether that makes sense to just buy an outright put. But the other would be just to do a put spread. So the lower cost conservative and defined risk approach would be a put debit spread.